Welcome to our lecture video. In this lecture, we will study project risk, scenario analysis, and managerial flexibility. When we evaluate a capital budgeting project, it is tempting to look at one net present value estimate and treat it as the answer. But in finance, we have to be careful. A single NPV number can look precise, even when the assumptions behind it are uncertain. Cash flows are estimates, not certainties. Sales volume, selling price, costs, timing, taxes, working capital needs, salvage value, and project life are all based on forecasts. Some of those forecasts may be close to reality. Others may be very wrong. So a good project analysis asks two broad questions. First, what is the project worth under the assumptions we believe are most reasonable today? Second, how much could that value change if those assumptions turn out to be wrong? The first question gives us the base case valuation. The second question leads us into risk analysis. In this lecture, we will look at scenario analysis, sensitivity analysis, break-even analysis, and real option reasoning. Together, these tools help managers understand not only whether a project appears valuable, but also where the risks are, which assumptions matter most, and what actions may be available if conditions change. The goal is not to predict the future perfectly. The goal is to make better decisions under uncertainty. Let's begin with forecasting uncertainty in capital budgeting. A capital budgeting forecast is uncertain because it combines many different types of assumptions. Some assumptions are operating assumptions, such as production volume, labor needs, logistics, and operating costs. Some are market assumptions, such as customer demand, competitive pressure, and selling price. Others are financial or strategic assumptions, such as discount rates, taxes, exchange rates, inflation, regulatory changes, and competitor behavior. One important point is that not all uncertainty matters equally. Some assumptions may change without having a major effect on project value. Other assumptions may have a powerful impact on NPV, even with a modest change. Those important assumptions are the ones managers need to study carefully. For example, demand uncertainty asks whether customers will buy more or less than expected. Price uncertainty asks whether the firm can actually charge the planned price. Cost uncertainty asks whether materials, labor, technology, or compliance costs may differ from estimates. Execution uncertainty asks whether construction, hiring, production, or launch timing may proceed as planned. There is also macroeconomic uncertainty, competitive uncertainty, regulatory uncertainty, and terminal value uncertainty. The key managerial task is to separate uncertainty that matters from uncertainty that only adds noise. We are not trying to eliminate uncertainty. That is impossible. We are trying to understand uncertainty well enough to make a disciplined investment decision. Good finance is not just calculation. Good finance is structured judgment. Let's now talk about the base case, upside case, and downside case. The base case is the set of assumptions managers view as the most reasonable planning estimate. It is the starting point for project evaluation, but it should never be treated as guaranteed. The upside case describes what could happen if important assumptions turn out better than expected. Demand may be stronger, pricing may be more favorable, costs may be easier to control, or adoption may happen faster. The downside case describes what could happen if important assumptions turn out worse than expected. Demand may be weaker, price pressure may be stronger, costs may rise, launch timing may be slower, or salvage value may be lower. In many business settings, it is better to use the terms upside and downside instead of best case and worst case. Why? Because realistic favorable and unfavorable cases are usually more useful than extreme stories. A scenario should not be a random collection of assumptions. It should be an internally consistent business story. In a downside case, low demand may come with weaker pricing, higher marketing costs, slower collections, and lower terminal value. In an upside case, strong demand may require capacity, capital, and operational readiness to capture the opportunity. A good scenario design asks managerial questions. Can the firm tolerate the downside? Does the base case create value under expected operating conditions? Does the firm have the flexibility to capture the upside? Scenario thinking helps managers prepare before capital is committed. Scenario analysis estimates project value under several internally consistent sets of assumptions. This is different from simply changing one input at a time. Scenario analysis changes a group of assumptions together because real business conditions often move together. Think about a weak economic environment. It may not only reduce sales volume, it may also reduce selling prices, increase customer defaults, delay receivables, increase inventory pressure, and reduce resale value. If we look at each variable separately, we may underestimate the total risk of a downturn. That is why scenario analysis is especially useful when risks are linked. When we evaluate scenarios, we usually begin with the base case. Then we examine a credible downside case and a credible upside case. The purpose is not merely to produce several NPV numbers. The purpose is to make risk visible. A good scenario analysis should answer several questions. What is the value of the project in the base case? How large could the loss be in a credible downside case? What assumptions must hold for the upside case to occur? Are the downside risks acceptable compared with the upside potential? What actions could managers take if the downside begins to appear? Sometimes analysts assign probabilities to scenarios and calculate an expected value. That can be useful, but we must be careful. Scenario probabilities can create false confidence because the probabilities themselves are uncertain. The individual scenarios still matter. Two projects may have similar expected value, but very different downside exposure. Next, let's look at sensitivity analysis. Sensitivity analysis changes one assumption at a time, while holding the other assumptions constant. Its main purpose is to identify the key value drivers of a project. A value driver is an input that has a large effect on project value. Common value drivers include sales volume, selling price, variable cost, fixed operating cost, initial investment, working capital requirements, project life, salvage value, taxes, and the discount rate. Sensitivity analysis is powerful because it tells managers where attention should go. If project value is highly sensitive to sales volume, managers should investigate demand more carefully. They may need better market research, pilot testing, customer commitments, or early sales indicators. If project value is highly sensitive to selling price, managers should study competitive pressure, customer willingness to pay, contracts, and pricing discipline. If project value is highly sensitive to variable cost, managers should focus on supplier terms, production efficiency, and input risk. If project value is highly sensitive to fixed costs, managers should think carefully about operating leverage. High fixed costs can make a project attractive when volume is strong, but dangerous when volume is weak. Sensitivity analysis can also guide negotiation and project design. If fixed commitments create too much risk, managers might consider outsourcing, leasing, staged investment, or more flexible contracts. The important idea is simple. Sensitivity analysis does not tell us exactly what will happen. It tells us which assumptions deserve the most research, monitoring, and risk management. Let's now turn to break-even analysis. Break-even analysis asks how much sales activity is needed for a project to reach a particular benchmark. In capital budgeting, there are several important break-even concepts, and they do not all mean the same thing. The first is accounting break-even. This is the level of sales at which accounting operating income is zero. It tells us how much volume is needed to avoid reporting an operating loss. But accounting break-even does not necessarily mean the project creates value. The second is cash break-even. This is the level of sales at which operating cash flow is zero. It tells us how much volume is needed to avoid negative operating cash flow. This is useful because cash pressure can create serious problems even when accounting measures look acceptable. The third is financial break-even. This is the level of sales at which NPV is zero. It is usually the most decision-relevant break-even concept because it considers the initial investment, timing of cash flows, terminal cash flows, and required return. A project can cover cash costs, report accounting profit, and still fail to earn the required return on the capital invested. That is why financial break-even is so important. Managers also use the margin of safety. The margin of safety tells us how much room the project has before sales fall to the break-even threshold. A larger margin of safety means the project can absorb more weakness before crossing the selected break-even point. At this point, we have several tools: scenario analysis, sensitivity analysis, and break-even analysis. Each tool answers a different question. Sensitivity analysis asks, which assumptions matter most? Scenario analysis asks, what happens when several important assumptions move together in a realistic business environment? Break-even analysis asks, what operating target must the project reach to satisfy a specific benchmark? These tools should be used together, not as substitutes for one another. Sensitivity analysis is useful, but it has an important limitation. It changes one assumption at a time. In real business, risks often interact. A decline in sales may occur at the same time as price discounts, higher marketing spending, longer collection periods, and lower terminal value. That is why sensitivity analysis should not replace business judgment. It helps identify the key assumptions, but scenario analysis helps us understand how those assumptions may combine. Break-even analysis then translates valuation risk into an operating threshold. Instead of only saying the NPV is risky, we can ask, what level of sales, pricing, or cost control is required for this project to succeed? This is very useful for managers because it connects the finance model to operating reality. A disciplined project review often follows a logical sequence. First, estimate the base case. Then identify key value drivers. Then build realistic scenarios. Then examine break-even thresholds. Finally, ask whether managerial flexibility can improve the risk-return profile. That final step brings us to real options. Traditional NPV analysis often treats a project as a fixed plan. Invest today, operate according to plan, and receive whatever cash flows occur. But many real projects are not that rigid. Managers can often change course as new information becomes available. Managerial flexibility is the ability to adapt project decisions over time. A firm may wait before investing, expand if demand is strong, abandon if demand is weak, switch inputs, change pricing, outsource production, or scale the project in phases. A real option is the value created by this flexibility in a real asset or operating project. It is called an option because the firm has the right but not the obligation to take a future action. The visual behind me shows the basic relationship between static project value and the value created by flexibility. I will not read the formula, but the intuition is very important. A project with flexibility may be worth more than the same project with no ability to adapt. Flexibility is more valuable when uncertainty is high, when managers can observe useful information before committing all capital, when the firm can act quickly, and when the cost of preserving flexibility is reasonable. However, real option reasoning does not mean every uncertain project should be accepted. Flexibility must be credible, actionable, and economically meaningful. In finance, the question is not simply, is there uncertainty? The better question is, can management respond profitably as uncertainty is resolved? Let's review common real options in capital budgeting. The option to delay means the firm can wait before investing. This may be valuable when demand, interest rates, permits, technology, or competitive conditions may become clearer over time. The option to expand means the firm can increase scale if early results are strong. A company might design a project so it can add capacity later, rather than committing to full scale immediately. The option to abandon means the firm can stop the project and recover some value if results are poor. This can limit downside losses, but only if the firm can actually sell assets, exit contracts, reduce costs, or shut down without creating larger problems. The option to scale back means the firm can reduce capacity, spending, or scope if adoption is slower than expected. This can help protect cash flow and preserve strategic flexibility. The option to switch means the firm can change inputs, outputs, technology, suppliers, or operating mode depending on conditions. But here is the key point. The existence of flexibility does not automatically create value. The option must be real. It must be available when needed. It must change cash flows. It must have a reasonable cost, and management must be able to act. Real options are often discussed qualitatively, but they should still be connected to cash flows. Managers should ask what decision could be made, when it could be made, what it would cost, what cash flows would change, and what uncertainty would be resolved before the decision. Let's finish by bringing the full project risk analysis together. Spreadsheet models are useful, but they can create problems if used mechanically. A model may display a precise NPV even when the inputs are rough estimates. Formulas may hide important assumptions about demand, timing, taxes, working capital, and terminal value. Inputs may be treated as independent even when they move together. Scenario probabilities may reflect optimism more than evidence, and model errors can distort the result. A spreadsheet should support judgment, not replace it. Managers and analysts should also watch for common errors. Do not treat the base case as certain. Do not change variables inconsistently. Do not ignore downside liquidity. Do not double count risk by using both overly conservative cash flows and an excessively high discount rate. Do not ignore operating leverage. Do not assume abandonment is easy. And do not assume flexibility is free. Before committing capital, managers should be able to answer important questions. Which assumptions have the greatest effect on NPV? How reliable are the data behind those assumptions? What is the credible downside loss? Can the firm absorb that downside? What early indicators will reveal whether the project is on track? Can the project be delayed, staged, expanded, scaled back, switched, or abandoned? These questions move capital budgeting from spreadsheet calculation to managerial decision making. The best project analysis does more than estimate value. It prepares managers to act intelligently as information changes. Thank you for joining me today. I hope this lecture helped you understand project risk, scenario analysis, break-even thinking, and managerial flexibility. I'll see you in the next video.